And if I was a Chinese strategist and I wanted to let's say, dethrone the dollar, which is their stated objective, the easiest way is to drive the gold price a lot higher. You've got here a trend which shows an increasing preference to hold gold among these let's say, I'm not going to say enemy central banks, but you get the idea. So this basically means gold must go a lot higher and substantially higher.
Hello and welcome back to Soar Financially, a channel where we discuss the macro to understand the micro. My name is Kai Hoffman. I'm the @JR Mining guy over on X, and of course, your host of this channel. And I'm really looking forward to this discussion. I was so excited when it popped up in my calendar because it's with Michael Howell. He's the king of liquidity. He's the liquidity king, and some call him on YouTube to call him the GOAT. But I'm really excited to have him on. Like, we've seen so many macro events happen that could impact global liquidity flows, and I'm really curious how that will impact and shape the financial markets and the global economies moving forward. We had the Fed rate cut. Of course, that's been 4 weeks now since we've seen that, but I haven't had a chance to catch up with Michael. So I'm really curious from a liquidity perspective, how is that impacting the financial markets? And of course, China stimulus. I keep reading articles that China is not stimulating enough. And then I read an article that GDP growth was higher in China than everybody expected. So we'll see if any of that makes sense and trying to make sense of it. Now, without much further ado, and while you hit that subscribe button, I'll switch over to my guest, Michael Howell. Michael, it is great to have you back on the program. I'm really and genuinely excited about this conversation.
Oh, great guy. Very good to be here. Much looking forward to it.
Yeah, same here. Let's dive right in. As I said, we have a lot to digest and a lot to chew through, and of course, lots of predictions to make here. But maybe we'll start at the top. And since we last spoke in about end of April, roughly, I think April 20th or so, we chatted last. How has the global economy changed, and what's the state of the global economy and the financial markets right now, Michael?
Well, I think what you've got to do is, first of all, distinguish between two things. One of the mantras we often think of is to say that strong economies don't always have strong financial markets, and weak economies very often do have strong financial markets. In actual fact, the best time for risk assets is when economies are sluggish and policymakers are trying to goose those economies by stimulating either in the form of more fiscal spending or more particularly in terms of adding liquidity to markets. And that's pretty much what's going on now. The world economy is not recessionary. That's tick that box. That's positive. But it's certainly not growing fast. Inflation is coming down, as we know. But central banks everywhere want to ease, and it's not just the fact they're cutting interest rates. They're actually telling us now. They're standing up and saying that we're going to cut next meeting. Jay Powell said, expect a 25 basis point cut at the coming FOMC. The governor of the Bank of England said, we're going to cut next meeting. We've been told that these monetary policy committees were data dependent and they were democratic committees. So central bank leaders standing up and saying rate cuts are coming is actually quite a significant point. And the worry has got to be is that they're kind of easing aggressively into a melt up in markets. But broadly for the near term, let's enjoy it. As we keep saying, we've been bullish since October of 2022, there's been an upswing in the liquidity cycle through that period. Liquidity drives markets, but more particularly if you've got a situation where the US economy is sluggish, where the Federal Reserve is desperate to ease by all accounts, and you've got China, which is suffering deflation, in other words, capping global inflation, what's not to like? In the near term, it looks pretty good. The problem is, once you get into 2025, there are challenges.
And we'll talk about those challenges, Michael. And not sure where to start because, again, so many topics to chew through. But one of the last things I wrote down is that the Fed is desperate. And the Fed is desperate to ease rates. And I retweeted you actually the other day when you said, well, they're not data dependent anymore. Because I think it was a Financial Times article that you posted on your X feed about yes, we are cutting rates, and exactly as you said, like, they're not data dependent anymore. They don't care. We're going to do it anyway, right? But we got to talk about the motivation and what has led to those statements, which are definitely not what we're used to over the last 2 years. So what do you think of the motivation here is, Michael?
Well, I think the thing is that at the end of the day, what really matters to policymakers is the integrity of their bond markets. Okay, we could dance on the head of a pin and say, is it inflation? Is it an employment mandate? I mean, that's what their public face is. But the reality is is when their sovereign debt markets become challenged, policymakers act, because that's what they've got to do, is to finance government. And you can see evidence in the case of the British gilt debacle in September of 2022, when the new Prime Minister, the incoming Prime Minister Truss, basically delivered a budget statement which the markets hated, and the British gilt market, the sovereign debt market in the UK, sold off aggressively. Now, the Bank of England turned in an instant from quantitative tightening to quantitative easing. So there is your example of what happens when you get a sovereign debt market under pressure. And I would say that if you look at the US, this is another thing that we've got to start thinking about seriously, because there's a whole raft of measures that are going through in the US that we call, somewhat flippantly, not QE, and not yield curve control, that are distorting the market significantly. And let me give you some evidence of that. If you look at what the Federal Reserve has been doing, and I can demonstrate that with some charts in a moment, but if you look at what the Federal Reserve has been doing, basically the Federal Reserve has been injecting liquidity into markets, even though the public face has been saying, we are undertaking QT, we are cutting back on our liquidity injections. Now, let me point you to a chart, because I sent some charts over, but it's basically quite a lot further down. Maybe I can do this because I know where it is. So let me whiz through these as quickly as I can. Sorry, I've gone too far, so just bear with me. So there, right. So if you look at this chart, what this shows you is the Fed balance sheet, which is the red line you can see in the big chart, which is basically peaking, and then it looks like a hump and it starts to go down. That is the Federal Reserve undertaking QT publicly. That's the headline figure. But the orange line that is drawn behind that represents the liquidity injections that the Federal Reserve puts into the system. So in other words, it's balance sheet operations and not entirely liquidity creating. Some elements destroy liquidity, some create liquidity. So you've got to look at the orange line to say, what is the truth here? What's the true number of injections, true amount of injections? And you'll see that there's an inflection in that orange line, which occurs in late 2022. That was the British gilt crisis. That was a wake-up call for policymakers worldwide to say that we can't keep squeezing these markets because you're going to get disruption in our sovereign debt markets. And then you see the SVB, the Silicon Valley Bank failure, in March of 2023. And that's another instance where you see this step up in liquidity. And broadly, over the last 2 years, what you've seen is a gradual trajectory towards rising liquidity in the US market. So this is a key factor that we've got to start understanding, that this is really the reality. Now, the next slide is maybe a little bit wonkish, but it maybe shows exactly as well what's going on. And this is what we describe as I say, not QE, not quantitative easing, but it really is quantitative easing. And this is showing bank reserves in the US system. This is the key thing for understanding liquidity in American money markets. And at the end of the day, that's sort of the beating heart of the system. The orange line is overall bank reserves. And this red line that we've drawn just below is a 1 standard deviation drop below that to indicate the stress that is occurring in the regional banks, the small banks that maybe have less ability to garner reserves. And that's where you get this threshold that we've drawn, which is the threshold for adequate reserves. Anywhere below that creates tension in money markets, in our view. So that's the line you dare not cross. And what's happened is that Fed liquidity was sluggish, sufficiently sluggish to push this red line down below. And what have they done? They've changed the rules here, which is why we've got this step down in August, where they changed the rules on bank stress tests, where they now said from going forward, banks can now use borrowings at the discount window at the Fed, ability to use the standing repo facility, and any borrowings from the Federal Home Loan Banks, which is a government-sponsored enterprise, in their stress test. So it immediately releases, we think, about $800 billion back into money markets that the banks don't need to satisfy their stress tests. They can actually, they can, in other words, buy treasuries and then repo those treasuries at the discount window or the standing repo facility whenever needed. So it's given them a lot more flexibility. So what these things are basically saying is that what you've got, and I'm going to finish on this slide that I'm going to show you in a second, what you've got is the global liquidity cycle, which is the main driver of asset markets and economies worldwide, the flow of money through world financial markets, inflected in October of 2022, as you can see here, and it's rising and it's slated to peak in late 2025. And that red dotted line that we put on there is a sine wave. And just rest assured, we're not cheating too much here. We actually estimated that sine wave back in year 2000. So it's been running for 25 years pretty much now, as it was estimated on past data, and the frequency on the match seems to be pretty good. So it's not exact, but it gives you a context as to how markets and liquidity is basically playing out.
Couple follow-ups to that, Michael, and maybe in layman's terms, and explain it to me like I'm 5 years old, but where does the liquidity show up now? You said the bank balance sheet, they invest in bonds, it goes back to the Fed or the US Treasury, but maybe explain it in very simple terms so I and my viewers can understand it, but where does that liquidity show up? How is it helping and maybe supporting the economy in the US right now?
Well, I think the thing to say is that, you've got to think of liquidity as a pipeline. And that pipeline pretty much begins with the central banks. It then feeds through the financial system, and the financial system becomes more liquid. Banks start to create credit, collateral values rise. Those collateral values, such as rising bond prices or rising asset values, themselves facilitate more liquidity because you can borrow against collateral, which is a very important point to understand in the modern world. And that starts to inflate liquidity across financial markets broadly. And then that spills out. It spills out into asset markets. You tend to find that in the very early stages, the fixed income markets, the credit markets, and the forex markets are most sensitive to rising liquidity. Then it feeds through into equities. It starts to then hit the real economy. Commodity markets start to rise, and you get this general transmission of liquidity through the economy. And then ultimately, maybe we're talking about 2 years to 3 years later, it may start to appear in faster high street inflation, which is clearly a negative that will then cause central banks ultimately to come back and tighten. So that's really the process that we think of. And in fact, there's a slide which I can show you, which I'll put up, which gives you an idea of the sensitivity of different asset classes to a 10% global liquidity shock. So what that's really saying is that you get these multiplier effects, which is shown on the left-hand axis. So if you're looking at gold, which I know is a big focus of you and your listeners, if you look at gold, what that's saying is that for every, let's say, 10% increase in global liquidity, you're looking at something like a 15 to 20% increase in the value of gold. Silver tends to be more leveraged. But then if you start to look at the cryptocurrencies, what you'll see there are some very, very big responses of cryptocurrencies. I mean, you get the response that you can get 4 or 5 to 1 in terms of the leverage on those, in terms of response to liquidity. Now, it's important to distinguish in that chart the red bar from the orange bar. The red bar is data over a whole period. So we've looked here going back to about 2012, I believe it was, which is using weekly data and using regression analysis to basically show the sensitivity of these different asset classes. The orange bar is the last 18 months. And what you've got with cryptocurrency is obviously part of it's a learning effect. So those responses in the early days were highly, highly sensitive. And now they're coming down to more normal levels. So don't expect looking forward the same degree of sensitivity. Whereas gold and silver, which are much longer established asset classes, seem to have very stable responses. And one of the things that we keep saying, maybe it's becoming more and more obvious to everyone now, is that look, the reason that gold is at an all-time high here is that there's lots of liquidity, monetary liquidity in the system, and that is driving these asset prices higher. Silver will ultimately catch up; it always does. But it's as they label it sort of flippantly, it's the restless metal. It tends to have periods of strong outperformance and then dullness for a long time.
Yeah. No, since you have that slide up, I do have to ask because you almost answered that question. But Bitcoin, Ethereum, like how confident are you in that data? It's, as you said, like it's a very short time period that you have a track record of, like the association of gold, of Bitcoin and liquidity, global liquidity. Like how confident are you in that data? And I don't know, maybe a bit cheeky here, but isn't it too early to make those assumptions? I'm curious.
Yes, I think that's right. I mean, the answer is not so confident. I mean, one would have to say that in all truth, because it's a comparatively small sample. But I'm not an expert on Bitcoin nor on crypto generally. But the point that we've made to our clients is, look, what you see is what you get. You've got to accept the fact that these securities are behaving like monetary inflation hedges. That's what we've seen for the last 10 years. Will they continue to do that? I don't know. Will gold continue to do that? Yes, it will, because gold has got 2,000 or 3,000 years of long-term history of basically protecting investors against monetary inflation. And in fact, if I go on to, I think it's the next slide, it basically illustrates that process. And what we've got here, just for the record, is to show in orange there. This is the market value of gold in the world. So think of that broadly as the gold bullion price, but it's measured in terms of the size of the pool of gold. And the black line is global liquidity. So that is a measure of monetary inflation in the system. And what you can see is that the gold market is pretty much keeping pace with that. Now, it doesn't go step for step, but over the trend is clearly there, as you can see from the evidence in the chart. The dotted line that we show there, the black dotted line, for reference is American consumer price inflation. And the point about the chart and the reason for drawing it is that we keep saying and trying to hammer home that gold is not a high street inflation hedge. It's probably better than that, in fact. It's a monetary inflation hedge. And high street inflation is a cocktail of monetary inflation elements and cost inflation elements, or even cost deflation elements. So, for example, what affects the high street? It's partly the Federal Reserve or the Bundesbank or the ECB printing money, right? But equally, it's things like oil prices, taxes, technological changes, faster productivity, cheap Chinese goods. All these things come into the mix and affect the high street. Now, what you've seen over the last 50 years, as that chart indicates, is that monetary inflation has been way, way faster than high street inflation. And that's really courtesy of the fact that we've had huge technological improvements. We've had China, dumping cheap goods into the West, etc. And that's basically kept the price level capped, even though monetary inflation has been, excessive. Now, you've picked up monetary inflation in rising asset markets, and particularly the gold price. But it hasn't really fed through into that monetary stimulus has not fed through into the high street for the reasons that I cited.
No. I'm going to table the gold discussion for a second because I want to come back to the initial chart you've shown here of the global liquidity. I'm just going to bring that up real quick because I really want to understand the drivers of global liquidity right now and really work that out. I've hinted at some topics, of course, but I'm curious if there's any other liquidity shocks, I don't know, for lack of a better term, maybe pushing liquidity higher. But I mentioned China stimulus. We discussed the Fed rate cut. What else is going to push it higher towards that 100 level at the top of the sinus curve here, Michael?
Well, I think the main thing that's pushing it higher is central banks adding stimulus. That's one thing. And the other thing, as I alluded to earlier on, is that what you've got within the financial system is are sort of pro-cyclical mechanisms. Now, in other words, if asset markets go up, that increases the pool of collateral. And collateral is what is used for credit providers use that as security for future loans. So in other words, this monster feeds on itself. Now, this is a world that we are increasingly in, and it's a world that we've relatively recently got in ever since the global financial crisis in 2008. And if you go back to, a pre-2008 world, if you went to borrow from a bank or an institution, they would be lending much more on your future expected income or cash flows than your assets, right? Today, it's predominantly not what your prospects are, it's what assets you own. So what that does is it makes the financial system a lot more pro-cyclical. And it probably means, from a regulation point of view, that banks need to have more capital in their balance sheets to protect against these uncertainties, but that may be a different question. But ultimately, what we're really saying here is that if collateral values rise, so if asset markets rise, they're going to rise more because liquidity is going to be generated on the back of that rising collateral in the first place. So if the central banks start the snowball rolling, this thing can gather pace as it starts to accelerate. And that's basically what we're saying. So you've got to start understanding these collateral forces within the system. Now, there is a chart which I hesitate to put up, but I'll show because it's fairly wonkish, but it comes back to the sort of key points for sort of understanding what's going on in markets. Maybe I need to go back here. This is the structure of global liquidity. And I promise not to get caught in the weeds too much in this, but essentially what you've got is a pool of liquidity of 175 trillion. And that is an inverted pyramid that rests on a base, a shadow monetary base that includes the central banks and a pool of collateral. There's also some cross-border flows in there, but let's look at the collateral. That collateral is multiplied up into global liquidity, and that is the multiplier that you see over time. Now, what drives that multiplier is this, or to a very large extent this, which is the MOVE Volatility Index. Now, the MOVE Index is a measure of volatility across the US government bond term structure, okay? So in other words, it's the volatility of US Treasuries. And the reason for showing this, which is much more important, but equivalent to the VIX index for equities, the ones that everyone likes to look at, but the MOVE is far more important, because basically what it's telling you is how volatile or uncertain is that main collateral pool. So in other words, if US Treasuries start to be highly volatile, the market begins to break down, then there'll be bigger haircuts or cushions that are given by the credit providers on the collateral. So in other words, they'll say, look, okay, Kai, you're posting a bond for €1,000 or $1,000 here, but because bond markets are so volatile, I'm only going to lend you $900 against that collateral. So I'm going to snip the collateral because I'm very uncertain of the value. So the higher that orange line, the more uncertain the outlook, the lower the effective value of collateral, and the less liquidity there is in the system. So this is the other lever that one's got to think of, aside from the central banks. Now, what I'm arguing is that the central banks themselves are very keen to get these volatility levels in their treasury markets down. Because if you go above that danger line, which we've done a couple of times, that is when they really lose control of their bond markets. And that's when you start to get panic setting in by the policymakers. And what they're trying to do right now is to stem that volatility. Now, the Treasury in the US is doing things like Treasury buybacks, but they're also doing things like they're manipulating the auctions. So they're doing a lot more bill finance in America, and they're doing a lot more issuance of short-dated coupons. And although this is sort of getting a little bit wonkish, for example, Janet Yellen has cut the average tenor of bonds offered at US auctions by about 1.2 years in the last, 24 months. So that's quite a big drop in bond speak. So in other words, there's no long-dated coupons available. There's lots of short-dated ones. What does that do? It distorts the bond market. And, without, as I say, getting stuck in the weeds here, the implications of this is that the US Treasury yield, we think, the main benchmark for global investors, the US 10-year yield, is about 100 basis points too low. Because what they're doing is they're squeezing they're rationing or creating scarcity in the auctions. They're issuing lots of very short-term bonds, and they're basically starving the big institutions, the pension funds, of these longer-dated coupons. Now, why is that important? It's important for two reasons. Number one is that if the bond yield should be 100 basis points higher than it is, the yield curve in America would be positively sloped, and all these fears of recession would be thrown out the window, right? The second thing is that if you've got the accurate, more accurate bond figure, 100 basis points higher, what does it mean for break-even inflation in the US? It means that break-even inflation sure isn't 2%, it's nearer 3.25%. And that makes a meaningful difference when you start to evaluate asset allocation and choose monetary inflation hedges. So these are significant factors that are important. The other thing that you've got to throw into this mix which is why I'm leading up to a very positive statement about gold and monetary inflation and whatever, is that in this environment, if the government is issuing so much short-dated debt, right, lots of bills, lots of 2-year, 3-year, 5-year coupon bonds, rather than 20-year or 10-year or whatever, if they're doing that, who buys that stuff? It's the banks. And if the banks buy the bonds, it's monetization. It's purely printing money because bank balance sheets expand and traditional money supply measures expand, pari passu. And that's what we've got to start, acknowledging, that something like 3/4 of the expansion in American money supply this year has been debt monetization. Milton Friedman, who many people will remember, the arch monetarist, sadly no longer with us, he'd be turning in his grave at these things. Stanley Druckenmiller, the legendary American investor, in an interview about 12 months ago, when talking about the Federal Reserve and the US Treasury and the numbers they're putting out in this regard, he says, look, these are the numbers we used to expect from Argentina, not from the US Treasury. So I'm not suggesting for a moment that the US is going to enter into hyperinflation, but they're certainly charting a faster inflation path. They're creating monetary inflation, and that is why gold is at an all-time high. And if you look at these statistics, is that in the last 20 years, since year 2000, what's happened is the stock of US debt, US Treasury debt, has increased by 8 times. Now, which asset class has gone up 8 times in that period? In fact, gold has gone up 8.5 times through that period. So gold has actually matched the increase in US debt, and this fiscal laxness that you're getting that is embedded, not just in America, in Europe, in Britain, right across the world, is going to end badly for our financial systems, but it ends very well for gold.
Everybody, if you haven't paid close attention, you should rewatch the last 10 minutes or so. Like, Michael, you make some excellent points. I think you just explained the world to us, quite honestly, and how things are working. You've touched on so many points I wanted to follow up with you on. Like, one of them is you're obviously not surprised the 10-year yield is exploding. Exploding is a strong word. It's going higher, the yield, meaning bonds are going lower. But Stanley Druckenmiller, you brought up, he's short bonds, actually, so he's following your thesis to the T. He doesn't like what he's seeing at all. Like, he just was on an interview on Bloomberg and sort of repeated that as well. You just made sense of everything for me. Like, we could probably end the interview right now because you answered all the questions pretty much in the last 10 minutes, in my opinion. So if people didn't catch that, you should definitely rewatch that, because I don't even know how to follow up your
Well, let me add one more thing. Let me add one more thing, which, if I can put the slide up again, I'll show you something else, which is another point I think is well worth thinking about in this regard, and that's this chart. Now, if you were China and you wanted to derail the dollar, you've got 2 ways of basically doing that. One is that you basically create a rival currency. So you create a yuan, which everybody wants to hold, and it becomes the main transaction currency in the world. So that's one thing you do. That's a tough call because, most trade is still denominated in dollars. China doesn't have the banking network worldwide to create trade credits, etc. It'll be a long, long haul. We're talking, decades and decades and decades for that to happen. The other way you do it is basically you undermine the US dollar as a standard of value. And one of the ways to do that is to basically create a shortage of gold in the system. And what you do is that you let the dollar devalue dramatically against gold by basically pushing up the gold price. Now, this chart is basically showing what I think is an interesting, unworrying trend, particularly if you don't own gold. And this is the gold holdings of the BRICS, in black, as you can see there. Since year 2000, in terms of the how many thousand tons of gold BRIC policymakers own, the red line is the US gold stock, and the yellow-orange line that you see there is broadening out the BRICS to include the BRICS plus their friends who want to join the BRICS organization. The standard, it is the Saudi, Kazakhstan, etc. These kind of countries here, the Shanghai Accord countries, Shanghai Cooperation countries, plus countries like Saudi, UAE, etc. So what you can see is, as of the end of 2023, the stock of gold holdings among this group exceeded America's gold holdings for the first time ever, right? Now, the more that the dollar goes down against gold and the more that the gold price goes up in value, the more more questions people raise against the dollar. And that maybe is what they're doing. So what you've got here is a situation where, number one, America is creating monetary inflation. It itself is devaluing the dollar. Secondly, you've got a backdrop here, which is basically saying, look, China and its friends are accumulating gold. So they're doing something here very significant. And what you've got is a rising gold price. You just extrapolate these trends. Is the US going to stop printing money? No, because the deficit is blowing out. The fiscal framework of the US is, and for that matter, Europe, is just shot through because of aging demographics and inability to tax. I think central banks that are not part of the Western sphere. So if gold tracks global liquidity, what should we be expecting? If global liquidity, as we suspect, is rising now at a rate of 8 to 10% per annum, which is really simply taken from the growth in government deficits, if that's what's going on, it would double every 8 years, right? If the stock of liquidity doubles in 8 years, why shouldn't the gold price double in 8 years? Well, I think the point is that the market's never moved in straight
Fantastic,
lines.
Michael. I've finally caught my bearing again. I've been following and trying to digest here since you brought up gold.
I think if you look at the
might as well
next
stay on the
slide,
gold
you've got
topic
that
for a second. I'm just going to
time
flip back to a
series. What that
slide
gives
you've
you
shown
an
earlier. It's this
illustration
one,
about,
and you're showing the average beta versus the last 18 months, and a question popped into my head: do you see actually is gold overvalued right now?
Over the long term. Now, if you look at that orange line,
looking at this.
Okay, as I say, this is the market value of gold, not the gold bullion price. It's pretty much the same. That's at an all-time high. Gold's at an all-time high. I mean, we can infer that maybe that orange line could come back to trend. But what should you do? Well, okay. My view would be, as it comes back to trend, buy more, because you know that trend's going up. If the market is daft enough to basically undervalue gold near term, and you see a cyclical dip because buyers are exhausted, well, great, buy more. That's all I'd say. I mean, it looks to me that trend is embedded, but I think we need to understand why that trend is going up. Let me just show you a little bit later what's happening to debt dynamics in the US, and we can come back to the challenges for China as well. This is the backdrop for debt worldwide. Now, many people are going to be familiar with this. This is showing how much debt has grown over the period. The reason for singling out China in year 2001, the WTO entry, is that, in my view, that was the catalyst that caused the West to start accumulating large amounts of debt, because basically China was a huge challenge. It undermined the profitability of a lot of Western industry, and what it meant was that debt became the solution for many people's problems. And that debt escalation, I think, began around 2000, early 2000s, as that chart indicates. Now, one of the things about debt, which is what this chart emphasizes, is, and this is what the textbooks and what economists don't tell you, is that debt has to be repaid, right? This is not like an equity where you issue debt, an instrument in perpetuity. You've got to roll the debt. And if you issue a 5-year bond, you've got to pay, in theory at least, pay the debt back in 5 years' time. Now, spoiler alert, debt is never paid back. It's rolled over in aggregate. And so what happens is that over that period, you get, as the debt stock increases, the size of the rollover of debt becomes bigger and bigger and bigger. And if you just think of the math, for example, if you've got a $350 trillion debt stock worldwide, which is what we have, and you take an average of a 7-year duration or maturity for that debt, it means you've got to roll over, using simple math, $50 trillion of debt every year. Now, that's a huge ask against the backdrop where global liquidity itself, the stock, is $175 trillion. The world economy in size is about $120 trillion. So what we're talking about here is a vast amount of money that is required simply to roll over debt. Now, what I've drawn up in this chart, which is the slightly scary thought, is that if you look at this, the red line is what we want to see. This is new capital expenditure, right? This is what corporations spend on plant equipment, building a new chemical works, building a car factory, building infrastructure, whatever. This is the bedrock of economies and what drives productivity. So that's good. The brown line there is the size of the debt roll each year for the advanced economies worldwide. So in 1980, it was about 1-for-1. So capital markets were supplying capital, new capital, and rollover capital in equal amounts. By year 2000, you're up to 2-to-1. So in other words, there was twice as much debt roll as new capital. Now we're up to 3-to-1, maybe even challenging 4-to-1. So what you're saying here is that basically 3 in every 4 transactions in capital markets now are debt refinancing transactions. So capital markets are not the new financing vehicles that textbooks tell you where interest rates matter. Financial markets are now debt refinancing mechanisms where balance sheet capacity matters. And just think of this in these terms. If the Federal Reserve or if the US Treasury raise interest rates on their debt, right? Why should that slow the economy down when so many people own debt and they're receiving what is now $1 trillion every year as a transfer payment? Surely if interest rates go up, our incomes go up if we're bondholders, and so we spend more. So actually, paradoxically, in this world of excessive debt, rising interest rates are probably a stimulus rather than a constraint on economies. And this is the way that we've got to start thinking of the world. Now, the last thought about this is this one, is that if you look at the refinancing needs of economies, what this is telling you is that debt and liquidity must move hand in hand. Because if there's lots and lots of debt that needs refinancing, you need liquidity, in other words, balance sheet capacity in the financial system to basically refinance the debt. This is the long-term track for advanced economies. There seems to be a sort of an equilibrium around here, which is about 250, 260% or whatever. This is the long-term average. And when you start to see the economies moving above that, you tend to see financial crises, because that is the problem in refinancing. Now, we've adjusted this chart for what's called the maturity wall, which is the bunching of debt that needs refinancing. So this is giving you the effective amount pretty much every year. And what you can see is this period from 2015 through basically 2023, 24 was a very benign period. There was lots of liquidity in the system and debt rolled over pretty smoothly. But once you start to move up into this higher area, it becomes trickier. And one of the big problems we've got is something called the maturity wall that you'll have heard about, that many Wall Street analysts are describing. And that is because in the era of zero interest rates, a lot of corporations very cleverly thought, let's refinance here at zero interest rates, and we can basically extend our debt out into 2026, 2027, etc. Now, they were saying that in 2021 or 22 when rates were near zero. But the problem is that they've now got to refinance that debt next year or the year after at much higher rates. And they need balance sheet capacity to do that. And all this debt is kind of coming at once. And that's the problem the world economy faces. Well,
Two questions to follow up on, and my mind went to household savings, because when you mentioned like the bond yields and the interest payments funneling down into the system, maybe households own some of those bonds. The household savings rate, and I heard an interesting statistic in Germany the other day that the household savings rate is actually coming back up again. Germans are not spending right now. I'm not sure what that looks like in the US, but it's something that just popped into my head here.
I think there's
and the next topic that perfectly fits in that is liquidity crisis, right? So let's assume the household starts saving, but my main question is, like, do you see a looming liquidity crisis? Because it seems like we need more and more money to refinance what we're seeing. Ratios are expanding. And 2025, 2026, you mentioned the maturity wall and the great wall of debt we have to climb, just to quote your article that you put out the other day. Do you foresee a liquidity crisis is the big question.
That black line is going to go up. It may well still peak in late 2025. That's possible. You see historically that sometimes those peaks are lower. So it might be peaking here rather than up here, but it could be under some pressure. And we've got to distinguish the supply of liquidity, which is coming from rising central bank expansions of balance sheets or more liquidity from central banks, and because asset values are going up and collateral is rising, so you're getting banks lending more, from the uses of liquidity. And the uses of liquidity is shown here. So what I've basically said is that, look, these are some of the challenges that you've got for 25. Let's take the US Fed as an example. US Fed liquidity supply may be going up, okay? And I suspect in the next few months it's going to go up quite a lot, right? But then what you've got are a series of demands on that, which are already coming on that right-hand side of the slide. So I've spoken about one of those already, which is debt refinancing needs, which is later in 2025, but certainly in 2026. But markets are going to start to focus on that. The second thing is that I touched on is higher inflation needs, because I think the underlying level of inflation is higher. And if you've got policymakers that are effectively, easing now into a non-recessionary economy where you're looking at a melt up in asset prices, you know for sure that must be spilling over at some stage into faster high street inflation. It may not be 2025, but it's likely to be 2026. And that will mean that more liquidity is driving high street inflation, not asset price inflation. And then you've got the top element, which is Chinese demand. Now, this is a very complicated area, and I'm going to say a couple of words about this and try and explain the backdrop. But if you look at what China is doing and what it's saying, they're kind of two very different things. So what we've been led to believe here is there's a massive bazooka which is being fired at Chinese markets to try and revive the economy or turn the markets around. Well, let me say that may be happening, but there's no evidence of it yet. And I know there are sort of various protocol things that the Chinese have to do. They can announce the package, but until it's approved by effectively the Chinese Parliament, they can't name the amount of the package. So we don't know whether it's $1 trillion, $2 trillion equivalent, or whatever. But we know they're going to do something. But the one thing that I have said very clearly is that this is not going to be monetized. In other words, the People's Bank of China's balance sheet is not going to expand. Well, what that really means, in essence, is that they're going to take or tap existing savings to redeploy in the economy. And that's not really the solution to what China's problems are. What China needs is a big easing of monetary policy, because they've got debt deflation. And debt deflation is what crippled the Japanese economy in the 1990s. It's what ultimately hurt the Asian economies like Thailand and Indonesia in the late 90s. And basically, it's a problem that America suffered in the 1930s. And the only way out of that is a looser monetary policy and a much weaker Chinese yuan. Now, if the Chinese start to weaken the yuan, I mean, all bets are off on the gold price, because the Chinese will gravitate there very, very fast. But ultimately, this is the backdrop that we need to think about. In the short term, what you've got, let me try and pitch in with some evidence here on China. If I follow my chart, sorry, gone too far. This is basically what the Chinese are doing in their money markets in terms of liquidity injections. And this takes us up to the first half of October. In other words, very recent data. Now, what you can see here is that this line, the white line, is showing the size of liquidity injections. And here they're adding a lot. Here they're taking some out. Here they're not doing very much. And this is the last 3 weeks, right? Well, hang on. Does that show there's a bazooka? If there was a bazooka, we'd be off the chart. It's actually going down. It's negative. And what's more, if you correlate this chart here in orange with the black line. So let me just be clear what we're showing here. This is PBOC liquidity injections. The black line is what is called a nowcast of world GDP growth. So it's basically a model which is looking at trying to get daily estimates from lots and lots and lots of inputs as to what the world economy is doing on a daily basis. Okay, so this is giving you annualized world GDP growth. And there are things in like credit spreads, like commodity prices, like reports of reported economic data, lots and lots of different things. And what it shows is that the PBOC, the Chinese central bank, leads the world economy in its actions by about 3 months. So if they inject liquidity, the world economy tends to pick up. If they crash liquidity, the world economy slows down. And this is what they're doing right now. So what they're doing is something very, very different than what we've been told or been educated. Now, that's a worry. Clearly, the facts can change. I accept that. But it doesn't look very good in terms of their near-term intentions. So what I would suspect is likely to happen as this plays out is that, number one, the Chinese are basically saying what we want to do is to hold the yuan where it is against the US dollar, and we're tightening monetary policy accordingly to fulfill that goal. Now, that is a bad policy mix, and it's going to end badly for the Chinese, but it may put a lot more pressure on the ECB and the Federal Reserve to say, well, look, if China's tightening here, we can't afford to have economies slow. We're going to counter that by easing. And maybe that accelerates their easing in the near term. The problem is as you start to roll this movie on and you start to look towards the middle of 2025, if the Chinese and the world economies genuinely are slowing down, then there may be a great need for greater dollar liquidity in corporations worldwide as a protection if the world economy slows. And make no mistake, China is a dollarized economy, okay? Chinese banks have got big balance sheet exposure in gross terms to the US dollar, and Chinese corporations, in terms of their export markets, trade in dollars. They may not, they don't repatriate their dollars, they keep them offshore, but they're basically very dollar hungry. And if the PBOC is squeezing sufficiently, they may go out into dollar markets and try and borrow more dollars, which will then create more of a shortage worldwide. So what I'm trying to say is that now it looks great, okay, in terms of what the situation is. We're at all-time high for risk assets. Next year, you've got challenges. You've got 3 things that are coming up. What is the ultimate solution for those 3 things? It's more liquidity, because that's the, kicking the can down the road is what our politicians know best. So we've got to be cognizant of the cycle, but we also got to be aware that there's a whopping great trend here. And that trend means you've got to own gold. The cycle means let's try and trade this as best we can. And okay, let's, as they say, enjoy the party, but dance near the door. So keep an eye on risk. Well, let's answer the second one first, because that's the easiest one, Guy. What we do is we basically get rid of the 60-40 asset allocation model that everyone had been educated on the last 2 or 3 decades. 60% equities, 40%
it was supposed to be my last question here as well. Like, A, I'm going to steal from your script here, but what can policymakers do to protect investors? And B, what should we as investors do to protect ourselves? Because we can't really trust the policymakers, quite honestly.
So that's, these blue chip companies look great, I would think, on a medium-term view. Doesn't mean to say their share prices won't go down if there's a sell-off. They will, but then it gives an opportunity to buy more of what are probably good companies. So, the world is not going out of business. These things are still going to be producing. Do you want to own government bonds where the government is dedicated to increasing the amount of debt in the system by around 8 to 10% per annum? And I would think the answer to that's probably not. I certainly wouldn't want to be caught in that, particularly if you're buying longer dated debt. Okay, pension funds have to, banks have to, but the average individual doesn't have to do that. So I would avoid that. And what I would do is to think about that 40% that you've allocated to bonds in the past and start to parcel up by dedicated monetary inflation hedges, which means gold and, if you're inclined that way, Bitcoin. The second thing to do is to buy Treasury inflation-protected securities, so index-linked bonds. Now, there are not that many available in Europe, in the Eurozone. There are French index-linked, as I know, but the UK has index-linked gilts. But the US Treasury tips are, I think, a fantastic value right now. So I'd be buying that bit. I'd be putting more money into cash because I think that markets may, I'm not going to say they're going to hit a wall, but they're getting closer to the end. I mean, we've got to remember here that, we've had a bull market for 2 years now. Many people have refused to believe that. There's been a lot of pessimism, but then after all, markets always climb a wall of worry. So that's no great surprise. But the reality is that after 2 years of a bull market, you've typically, on average, have seen 80% of the ultimate gains. So we've got to be cognizant of risk in that respect. There's still more to go, I think. But, as I said before, I mean, enjoy the party, but just dance near the door in case there's a problem. And what I'd also be thinking about is prime residential real estate, because, that's a decent long-term inflation hedge. So I think that 40% could be sliced up in a different way. Have a bit of gold, have a bit of Bitcoin, have residential real estate as an investment, have Treasury inflation protected securities. But keep an eye, that 40% has got to be focused on monetary inflation hedges, in my view. Well, the easiest way is Capital Wars is a Substack publication that we frequently write 2 or 3 articles a week on what's happening on global liquidity, what's our narrative, how
Phenomenal.
we see
Michael,
things.
what a wonderful conversation. And I've taken a ton of notes, and I'll definitely have to rewatch parts of it. But I think you explained it perfectly, and really appreciate your time. Where can we follow more of your work? Like, how do we get more of your knowledge?
And then we have a Twitter handle, which is @CrossBorderCap for the occasional tweet. So those are the sources. And if you're inclined to read books, I read a book called Capital Wars about 5 years ago, the same title as the Substack, outlining this global liquidity phenomenon. Yeah, unquestionably. There's no way they won't, because the Federal Reserve balance sheet has to expand, and the only route they've got to do that is to buy government securities. So even if you look at the estimates, the official estimates.
Michael, I forgot to ask you one question. I'm going to do it now, because everybody switched off now. Nobody's going to listen to it. But I'm going to ask it anyway, because I'm curious what your answer to it is. But will the Fed start buying bonds? Will they have to start buying bonds at some point?
Maybe after this year. So it's there. I mean, they're going to end QT. They've de facto ended it anyway, but they're going to end it pretty soon, formally. Yeah. Great guy.
Yeah, it's another aspect of debt monetization you mentioned earlier. Yeah. So, but I forgot to throw that in there earlier. So, no, Michael, really appreciate it. Thank you so much for making the time. I know it's Friday, so enjoy your weekend, and can't wait to catch up with you again soon. we'll have to do this again. Thank you so much for your time, and to everybody else, thank you so much for tuning in here to Soar Financially. I hope you enjoyed this conversation with Michael Howell. I sure did, and I'm definitely going to rewatch that 10-minute part that I mentioned earlier. And there's so much in there because it really connects all the dots in the global financial markets, and a lot of the things we discuss here on the channel being connected here. So if you just watch 10 minutes of this interview, make sure it's that. I'll see if I can highlight it properly in the conversation, but that is really, really valuable, and I think that's something everybody should watch to understand what is happening in the world right now. If you haven't done so, please hit that subscribe button. It helps us out tremendously, reach a wider audience, educate other investors, and just inform you what is going on. So really appreciate that, and I'll see you in Frankfurt, Deutsche Goldmesse, November 21st and 22nd. Make sure to come out. Make sure to sign up. It's free for investors to attend. We have some great keynote speakers attending. It's not Michael, sadly, this time. We've had him on before. We'll definitely try to get him back in May. Michael, we'll have to talk about that at some point. And really looking forward to seeing everybody in Frankfurt if you can make the trip. Thank you so much for tuning in. We'll be back with lots more here on Soar Financially.